In the next week, you're going to buy stock in a company that loses $5 billion a year at the most expensive price tag in history. You won't click buy. You won't get a vote. You might not even notice it happened because somebody just quietly changed the rules inside your retirement account. Hi, I'm Stick Market, the distant cousin of stock market. He's the famous one. I'm the one who actually explains things. So let me draw this one for you. On June 12th, 2026, SpaceX went public. Biggest IPO in human history. It raised about $75 billion and got a price tag of roughly $1.75 trillion. That's bigger than every U.S. defense contractor combined, bigger than Coca-Cola, McDonald's, Disney, Nike, and Starbucks, all added together. Here's the weird part. Add up all of SpaceX's businesses last year, and the company lost about $5 billion. So, who pays a record-breaking trillion-dollar price for a business that's losing money? That's the mystery. And the answer is sitting in your 401k. Stick around, because by the end, you'll see exactly how the rules got bent and what it teaches you about your own money. A trillion-dollar price only makes sense if SpaceX is the company everyone thinks it is. So, what does SpaceX actually sell? Ask 10 people and they'll say rockets. Not wrong, but not right either. SpaceX is really three businesses stacked up like kids in a trench coat. Let's meet them. First, the one on the label, rockets. It launches satellites, cargo to the space station, astronauts for NASA. Real, impressive, and hard. And last year, it brought in about $4 billion. Sounds huge until you hold it next to a $1.75 trillion price tag. Rockets were only about a quarter of the company's sales. So the famous part isn't the important part. Business 2 is the one nobody pictures, and it pays for everything. Starlink, internet from space, thousands of little satellites beaming Wi-Fi down to a dish on your roof. Picture the cable company, but in orbit, except this one actually works. In 2025, Starlink pulled in about $11.4 billion, 61% of all of SpaceX's revenue. And the jaw dropper is the margin, around 63 cents of profit on every dollar and climbing. This is the crown jewel, the cash machine, the cash cow of Elon's businesses. Business 3 is the brand new one. In early 2026, SpaceX merged with Elon's AI company, XAI, behind the Grok chatbot and the platform formerly known as Twitter. The deal valued XAI at $250 billion. For comparison, OpenAI and Anthropic each earn far more than XAI but are valued lower per dollar of sales. So XAI got priced like a first-class airline, while earning like Spirit Airlines just before they went belly up. And it's burning through roughly $1 billion a month in losses. If Starlink is the cash machine, XAI is the cash bonfire. So, put the trenchcoat kids together, a rocket business doing fine, a Starlink machine printing money, and an AI lab setting money on fire. Net result last year, about $18.7 billion of revenue and a $5 billion loss. Is SpaceX an amazing company or wildly overpriced? Honest answer, it can be both at once. In fact, independent analysts at Morningstar pegged its fair value at roughly half the IPO price. So we're back to the mystery. Who pays full price for a money-losing company that smart analysts say is worth half? You do. Not because you chose to, because of a machine most people have never looked inside. Let's open it up. If you have a 401k or an index fund, you probably own an index fund. Remember our index fund lesson in our last video? Then you know. An index fund automatically buys the 100 biggest tech companies. That's passive investing, and honestly, it's usually great. Low fees, instant diversification, set it and forget it. But here's the catch nobody mentions. An index fund doesn't think. It buys whatever company is on the list. So the real power isn't the fund. It's whoever decides what gets added to the list. Get added, and hundreds of funds are forced to buy you. Billions of dollars, no questions asked. Now watch what happened right before the biggest IPO ever. The keeper of the famous tech list, NASDAQ, quietly changed 3 rules, effective May 1st, 2026. Rule 1, the waiting period. New companies used to wait about 3 months before joining the index, time for the market to find a fair price. The new rule cuts that to about 15 trading days. 3 months of price discovery squeezed into 3 weeks. Rule 2. The size of the slice. To join, a company used to need at least 10% of its shares available for the public to trade. SpaceX floated only about 4 to 5%. Under the old rule, disqualified. So the rule got removed. And rule 3 is the sneaky one. For companies floating less than 20%, the index now counts the float as 3 times bigger than it really is. A 4% slice gets treated like 12. A 5% slice like 15. It's like bringing one cookie to a potluck and getting credit for 3. Put the 3 together and you get manufactured demand. A money-losing company skips the line, skips the weight, and the funds get nudged to buy more of it than its tiny float should allow. And here's the uncomfortable part. The early owners and the insiders sell. The buyers showing up to take those shares at the top? Passive funds, your retirement account? One portfolio manager put it bluntly, your 401k is the exit liquidity. The early folks cash out near the peak. And the index quietly hands their shares to you. No vote, no click, no phone call. So, did the machine work? Watch. SpaceX priced at $135 a share. It opened at 150. Day 1, it spiked to about 176 and closed around 161, up 19%. A few days later, it was trading north of $200 with an all-time high around 226. From 135 to 226, up about 2/3 in its first week. It instantly became the 6th most valuable public company in America, worth over $2 trillion. Traders were so hungry that brand new 2 times leveraged SpaceX funds launched and did over $1 billion of volume on day 1. Now hold 2 numbers side by side. The market is paying around $200 a share. Those independent analysts, they think it's worth closer to half the IPO price or $70 a share. So the stock didn't rocket because the company suddenly earned more money. It earned exactly the same. It rocketed because demand was manufactured. Forced buyers arriving right on schedule, exactly like the new rules were built to make happen. The thesis didn't stay a theory. It printed in green candles on the stock chart. Now, this isn't a passive investing is bad lesson. It's still one of the best tools normal people have. The lesson is subtler, and it's the whole point of this channel. The same feature that makes index investing easy, it buys the list for you, is the feature that makes you an automatic buyer of whatever squeezes onto the list. Convenience and blind spot are the same coin. And being added to the index is not a gold star that says good investment. It just means it qualified. So, what do you do with this? Nothing dramatic. And remember, I'm a stick figure with a marker, not your financial advisor. 3 quiet moves. Number 1, know what's actually in your index funds. Peek under the hood now and then. Number 2, remember that it's in the index is not the same as it's a good price. And number 3, keep doing the boring stuff that always wins. Invest consistently. Keep fees low. Think in decades, not weeks. Which leaves the big question. And I genuinely want your take on this one. Where does SpaceX go from here? It's a tug of war. On one side, forced demand. As more shares unlock and more index funds pile in, that pushes the price up. On the other side, gravity. A money-losing company priced at roughly 3 times what careful analysts say it's worth, that pulls it down. Which force wins? Nobody actually knows. And anyone who says they're certain is selling something. So tell me in the comments. Does forced demand keep it flying? Or does gravity win? I read every single comment. Here's the whole picture in one breath. The biggest IPO in history. A company that lost $5 billion. 3 quietly rewritten rules. A stock up 2/3 in a week on demand instead of earnings. And a retirement account. Yours. Gently drafted as a guaranteed buyer. Not a scandal exactly. Just the plumbing behind the walls nobody shows you. If this made the system click in your head, hit subscribe so the next video finds you. And I have links in the channel description below called Drawn to Wealth, the Stick Budget System, and a discounted bundled price for both tools in the description below. Passive investing was sold as set it and forget it. Just don't forget that something's always deciding what you buy. Until next time, keep it simple and keep building.